Good morning and welcome to Finley Davies' webinar on pension plan funding strategy in light of HATFA. If you don't see the presentation, click on the blue and green ball icon on your bottom toolbar. If you'd like to print a copy of today's presentation, you can click at the top, File and Print. The presentation is also posted on our website. For questions during the webinar, please type them in the chat area, which is hidden if you hover at the top of your screen. We'll address all questions at the end of the presentation. This session is being recorded, and we will post it on the Finley Davies website on Friday. Pension funding strategy is a complex topic, and our goal is to make it as easy to understand as possible. So let's dive right in. First, I'd like to introduce David Davala, a senior consultant in our actuarial services practice. He has more than 25 years of experience in management of actuarial valuation processes, measurement and consulting for Taft-Hartley funds, accounting measurements under ASC, and forecasting of pension plans. Dave is a member of the American Academy of Actuaries and an enrolled actuary. Our second presenter, Amy Gentile, is a senior actuarial consultant who co-developed our firm's proprietary software for benefit calculations and valuation reports. She develops exhibits for various plan design possibilities, prepares non-discrimination tests, provides projections, and assists with changes in plan design. Amy is an enrolled actuary. And now I'll turn things over to Amy to begin the webinar presentation. Amy?
Thank you, Lisa. Thank you to everyone for joining us today. Dave and I hope to highlight some of the outcomes we've seen as a result of the HATFA pension relief recently passed. To begin our presentation, we will do a brief overview of HATFA, outline some pros and cons that HATFA brings to pension plans, and we will also review the various decisions that many plan sponsors will need to make. What we hope to be the most interesting part will be the 5 case studies that we will review. Our goal was to review scenarios that many plan sponsors would be able to relate to. If time allows, we will address questions at the end. If we do run out of time, feel free to reach out to Dave or myself should you have any questions. So what is HATFA? HATFA is the Highway and Transportation Funding Act. The act was signed into law by President Obama on August 8th. The law was passed to help fund various highway programs through the Highway Trust Fund. Part of this funding comes from the pension relief that the law provides. This relief is effective starting with 2013 plan years. Since the relief was passed so late in 2014, plans can elect to delay HATFA until 2014 and keep their 2013 valuation results under pre-HATFA rules. As a result, this leaves plan sponsors with many questions as to what is best for their plan. What has slowed the decision process down is that guidance regarding how to apply HATFA hadn't been released yet, so advisors were working under assumptions of what they assumed the relief would allow. IRS finally released additional guidance on September 11th as IRS Notice 2014-53. This notice provided answers to many of the questions plan sponsors and advisors both had regarding the application of this relief. The pension relief provided by HATFA is an extension of the relief passed in 2012 under MAP 21, the Moving Ahead for Progress in the 21st Century Act. The original relief under MAP 21 applied a corridor to the current funding interest rates. Current rates are based on a 24-month average of spot rates, which are illustrated on this graph as the solid dark blue line. MAP 21 utilizes a 25-year average of the interest rates to develop a corridor which establishes minimum and maximum rates that are allowed to be used for funding calculations. The corridor for 2012 was based on 90% and 110% of these rates, and then it was to expand by 5% each year until we got to 70% and 130% in 2016. These MAP 21 rates are illustrated by the blue area in the chart, which you can see slowly expands until 2016. Since the dark blue line, or the current 24-month interest rates, are below the corridor, MAP 21 allows us to bump the interest rates up to the bottom of the corridor. If these rates had been above the corridor, we would have lowered the rates down to the top of the corridor. So what did HATFA do? HATFA slowed down this expansion of the corridor and allowed plan sponsors to stay at the 90% and 110% limits through 2017, and thus utilize higher interest rates for a longer period of time and decrease liabilities. The HATFA rates are illustrated by the narrower orange area of the chart, which doesn't start to expand until 2018 and then continues to expand until 2021. 2021 is when the impact of HATFA will be gone, and we will be back to the corridors that MAP 21 had originally outlined. It is also interesting to note that, as shown by the dark blue line, by 2021 we anticipate MAP 21 to have little to no impact because the 24-month spot rates should be within the permitted corridor. Now Dave will go over some of the pros and cons that HATFA brings to pension plans.
Thank you, Amy. As the graph demonstrates, HATFA raises the interest rates used to calculate funding liabilities. Higher interest rates mean lower liabilities. This will reduce your funding requirements for the 2013 plan year if you choose to do so. If you had already contributed the required MAP 21 minimum amount for 2013 and decide to use HATFA, you can add to your pre-funding balance. The pre-funding balance can then reduce future contribution requirements. The lower liability will raise the funding percentage. The increase could be enough to avoid benefit restrictions such as paying lump sums and increasing benefits. The higher funding percentage could also avoid the increased contribution requirements that go with being in an at-risk status. The increased funding percentage could also eliminate a new shortfall funding base and/or eliminate all previously existing bases. You could also lower your 2014 PBGC premium by redesignating 2014 contributions to the 2013 plan year. An example of this is where 2014 quarterly contributions are redesignated to the 2013 plan year. This would increase the market value of assets used to calculate the PBGC premium. There are some negative aspects of HATFA. The interest rate relief is temporary. Contributions are merely shifted to the future. If elected for 2013 and there are receivable contributions included in the 2014 asset value, then the asset value for the 2014 plan year will be lower due to the larger discounting factor. This could increase your PBGC premium and your minimum required contribution. If your plan pays out lump sums, the increased funding percentages could allow full lump sums to be paid. Under the current interest rate environment, the cash paid out for a lump sum is greater than the liability released. The lower contribution will lower your accounting funded status also. Decisions for plan sponsors. Plan sponsors can retroactively elect to use HATFA for 2013 even if the 2013 5500 filing has been submitted. The deadline to switch is the later of the 5500 filing and 12/31/2014. If you want to redesignate a contribution, the deadline is the 5500 filing. A reason to redesignate a contribution would be to change the plan year that it is assigned to, or use all or part of a 436 contribution to meet minimum funding requirements. A 436 contribution is made to raise the funding percentage to avoid benefit restrictions or to increase plan benefits. A plan sponsor also has the chance to revoke a credit balance waiver. Waivers are usually irrevocable, but it is being allowed for the HATFA transition. Examples are where the credit balance waived exceeds the minimum required contribution or where there were waivers to avoid at-risk status. Plan sponsors should realize that a defined benefit plan is a legal commitment to provide a benefit amount to each participant. Sooner or later, all the required funds to pay the benefits must be accumulated. Now Amy will show us some case studies. Our goal is to address some strategies that could apply to your plan.
Our first case study is going to show how HATFA can even help a well-funded plan. The prior HATFA columns illustrated what the 2013 and 2014 valuation results were prior to HATFA passing. This plan had contributed enough money to be 100% funded for the 2013 plan year. Since the plan was at 100% funding, they were able to eliminate all prior shortfall bases and thus zero out the shortfall installment portion of their minimum contribution requirement. They did still have a contribution requirement, though, because of the normal cost of $103,000. Then for 2014, the plan ended up dropping below 100% and had to establish a new shortfall base of $100,000. As a result, their minimum required contribution now also included a $20,000 shortfall installment on top of their now $100,000 normal cost. So the 2014 minimum required contribution was $120,000. So what could HATFA do for them? For 2013, applying HATFA increased their funding percentage to 104%. They still were able to eliminate all prior shortfall bases and not have a shortfall installment in their minimum required contribution. The added bonus was that now they have overfunded and could offset their normal cost by the excess assets that HATFA created. Now they have a zero minimum contribution requirement for 2013. Then, in 2014, after reflecting HATFA for both years, they remain over 100% funded and avoid new shortfall bases. They also continue to have excess assets and thus a zero contribution requirement. As a result, the plan sponsors did choose to elect to apply HATFA starting with the 2013 plan year. Their strategy was to eliminate contribution requirements and avoid setting up shortfall bases. They originally had contributions due September 15, 2014 and September 15, 2015, but now the earliest they will need to fund the plan will be April 15, 2016. Our next case study will outline how HATFA can also help plan sponsors plan ahead to reduce future contribution requirements. This plan sponsor funds their plan above the minimum required every year. Our first set of numbers for this scenario illustrates the results for 2013 and 2014, assuming HATFA was not elected in 2013, but has already been applied to 2014. Prior to HATFA being passed, they were 92% funded for 2013, and had a funding shortfall of $9.7 million. This funding shortfall yielded shortfall installments totaling $3.06 million, which when added to the normal cost of $320,000, their minimum required contribution was $3.38 million. Because of excess contributions they made in the prior year, they had a pre-funding balance of $6.7 million in 2013. For 2013, they ended up contributing $6.25 million, which is greater than the minimum amount of $3.38. So the pre-funding balance grew even more into 2014 to $10.6 million. In 2014, they contributed enough that they achieved 100% funding when ignoring their pre-funding balance. As a result, they did not need to set up a new shortfall base, but still had to carry their old shortfall bases. So for the minimum contribution requirement, we have a normal cost of $560,000 and the same shortfall installment amount for 2013 of $3.06 million, for a total requirement of $3.62 million. Note that the significant increase in the normal cost is a result of the hike in PBGC premiums from 2013 to 2014. So how could HATFA help a plan that funds over the minimum requirement and is 100% funded? Let's look at 2013 after HATFA. Their funding target dropped by $5 million, and thus their funded percentage, ignoring the pre-funding balance, is 103%. So the plan is now exempt from setting up a new shortfall base in 2013. The result is that the shortfall installments included in the minimum contribution requirement is back down to their 2012 amount of $1.7 million, and thus a contribution requirement of just over $2 million. This is a drop of about $1.5 million in contribution requirements. The plan still paid $6.25 million in contributions for 2013. So when we get to 2014, we now have additional excess contributions to add to the pre-funding balance. Our 2014 pre-funding balance is now $12 million. Continuing through the 2014 valuation, the plan remains at 100% funded and is thus still exempt from setting up a new shortfall base. So our minimum contribution requirement of $2.26 million is made up of the normal cost of $560,000 and the same shortfall installment as 2013 of $1.7 million. The plan will then have excess contributions from 2014 that can continue to increase the pre-funding balance for 2015. The end result was for the plan sponsor to apply HATFA to 2013, but not for the strategy of reducing contribution requirements since they have the cash available at this time. but instead, the strategy is to build up their pre-funding balance so they can have money for a rainy day when the cash isn't as accessible. The other advantage to their strategy is that they should continue to see lower contribution requirements because of being exempt from the new shortfall basis.
Case study number 3. This sponsor's funding policy is to save cash and contribute the minimum amount. Prior to HATFA, the minimum for 2013 was $840,000, and for 2014 it was increasing to $900,000. They were also paying a PBGC premium of $52,000. The 2013 results under HATFA show a decrease in the minimum of $66,000. All of this was due to the lower shortfall installment created in 2013. The normal costs remained the same since this plan is frozen. The normal cost consists solely of administrative expenses. The 2014 results under HATFA show an even larger decrease in the minimum from the prior to HATFA results. Just like in 2013, the decrease is attributable to the lower shortfall installment. 2014 decrease is larger since the HATFA relief is greater for 2014 than 2013. You should note that the actual value of assets is lower post-HATFA. This is because a contribution for 2013 was redesignated to 2014. This results in less of a receivable contribution at the beginning of the 2014 plan year. Another reason is that receivable contributions are discounted using the higher effective interest rate of 6.57 versus 6.21. Even though the actual value of assets is lower, the higher interest rates result in lower shortfall and thus a lower minimum required. The lower asset value results in a higher PBGC premium though. For this plan sponsor, electing HATFA helps them with their desire to preserve cash and contribute as little as possible. Case study number 4. The sponsor of this plan has the capability to contribute cash. They are balancing contributions with their taxable income. Plan contributions are often influenced by how much taxable income they want to offset with pension contributions. The 2014 column in this case are the HATFA numbers. For 2013, this plan has a pre-funding balance of $686,000. The plan is frozen, so the normal cost consists solely of administrative expenses and is $83,000. The shortfall amortization is $699,000 for a total minimum of $782,000. If they would elect HATFA for 2013, the shortfall amortization would decrease to $580,000 and the minimum would decrease to $663,000. Electing HATFA for 2013 has a surprising effect on the 2014 minimum contribution. As with the prior example, the asset value has decreased. Also, the normal cost goes up by $2,000, even though the plan is frozen. This is because the 2014 PBGC premium is recognized in the 2014 normal cost. The PBGC premium increased because the asset value decreased. The end result in this case, the 2014 minimum, is slightly higher when HATFA is used for 2013. The 2013 minimum was slightly lower though. Was significantly lower though. The plan sponsor in this case decided to not use HATFA for 2013. They had already planned for contributing the pre-HATFA 2013 amounts, and they did not want to go through with the added cost of restating 2013. Now Amy has one more case study to show us.
Okay, now let's take a look at our last case study. This case study looks at a plan sponsor who, again, is well-funded. Their strategy was to reduce their PBGC premiums without putting in additional cash contributions. So let's see how they managed to do that. First, take a look at 2013 and 2014 prior to HATFA. For both years, they were 100% funded and thus exempt from shortfall installments. Their only contribution requirement was the normal cost. This was $1.3 million in 2013, and then the plan froze at the end of 2013, so the 2014 normal cost was only their administrative expense of $104,000. They also had PBGC premiums due for 2014 of $71,000. Originally, they had designated $3.4 million in contributions for 2013 and $500,000 for 2014. The strategy at that time was just to get to 100% funded for 2014 with 2013 accrued contributions, while still satisfying the contribution requirements for 2014. If they delay HATFA until 2014, their 2013 valuation results do not change. When we get to 2014, it was easier to attain 100% funding, so we were able to recharacterize contributions and apply an additional $100,000 to 2013 to bump up the assets for 2014. The most tangible benefit from this was the drop in the PBGC premium to $67,000, which also decreased the minimum contribution requirement because they pay their PBGC premiums from the trust. So the strategy of the plan sponsor was to not apply the relief to 2013 since they had already funded over the minimum, but they did recategorize contributions so that it could reduce the PBGC premium. This ends our review of the case studies, and we do hope you found them interesting and that they gave plan sponsors something to think about regarding their own plans. So what should plan sponsors do? Plan sponsors should take a minute and determine what is their primary focus. For example, do you want to reduce cash contributions? Are you interested in adding to your pre-funding balance so you have money set aside for those rainy days? Are you focused on your accounting results and want to maintain or improve the funded status on an accounting basis? Do you want to focus on reducing PBGC premiums? Once you know what your primary focus is, you should reach out to your plan actuary and determine what the best strategy is to achieve these results, and if HATFA will help you get there. HATFA could also be hindering this goal, so you should discuss what actions need to be taken to still achieve it. That concludes our presentation portion of the webinar. Let's move on to the questions we have received. If you do have a question, please send it through the chat window at this time if you haven't done so already. You can also reach out to us directly if you do prefer. We'll wait a few seconds to see if anybody has any questions. Okay, it doesn't look like anybody has any questions. Again, feel free to reach out to one of us directly if you do think of one later. We have covered quite a bit of information in a very short time. We are always available to answer questions, either via phone call or email. As we mentioned earlier, the recording of this meeting will be posted on our website, so you can listen to it again. That should be posted later today. Thank you very much for joining us.